So December tends to be a good month. Importantly, though, January also tends to be a good month with about the same return. So we're staring down the barrel of the next 2 months, seasonally being very, very important. That does not guarantee anything by any means for all of you who play in the financial markets world. But what I would liken it to is a blackjack game or a hand of blackjack. And if you're looking at holding a 19 and the dealer has a 6, historically you've got about a 70% probability of winning that hand, and it's exactly the same here for December and for January. Welcome to RenMac Off Script. We're going to discuss markets, economics, policy, history, and life. Today is the 29th of November, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to touch on tariffs. We're going to touch on seasonality for the market. We're going to touch on a slew of the economic data. But Neil, you are in an undisclosed location celebrating Thanksgiving. It looks like. How's the turkey day for you?
I'm in the battleground state of Arizona. No longer a battleground, swung pretty hard to the right like most everywhere else. But yeah, we're in Scottsdale. The coolest thing I have done so far, I must tell you, I went in a Waymo, self-driving Uber, basically.
Yeah.
The most amazing experience, I've got to say. I mean, my daughter was freaking out. She was like, I want a car with someone driving. And I'm like, look, little one, if you got into a car, a yellow taxi in New York City, this Waymo is safer than whoever's behind the wheel of that car.
Right, so right. It could be worse. It could be your mother driving.
Yeah, right. But yeah,
does it have a steering wheel?
It's so basically it's like I guess it's like an electric Jaguar, like an E-Pace or something, and they basically retrofit it with all sorts of gadgets and gizmos. There's like a thing on top. There's like something on the in the front, and yeah, I mean it's you can see the wheels, the steering wheel moving while you're in there. But yeah, I mean there's nobody actually behind the wheel.
And what was your top speed?
45 miles an hour.
Oh, that's pretty good.
But it was all on local roads. I mean, it's it's obviously. But I will tell you, like, if it sees a car in front of it that's going slower than the speed limit, it'll shift lanes and then pass if necessary.
Right.
So it's kind of, I mean, it's like it's all very safe and everything, but I mean, it's like, oh, it's switching lanes to make a pass. That's pretty cool, you know.
Well, we had a torrential downpour here for Thanksgiving, and worse than that is the Darien football team got absolutely dismantled by the New Canaan football team. We were both 8-1 or 9-1, I can't remember, but it was kind of a big deal to seeding for the state finals. But it was absolutely torrential. I've never sat in rain like that before, but terrible outcome. Anyway, turkey was good. How about you, Steve? All good?
All good in our home front. Little guys eating a lot of turkey. Nothing really to add.
There we go. Everybody a Lions fan now. Everybody's a Lions fan, especially Neil. All right, Neil, I'll take my boot off your neck here from a football perspective. But let's talk a little bit about last week because there was a lot of stuff going on. You had housing, which was disappointing to say the least. You had confidence, which is running pretty hot. Philly Fed, Chicago PMIs, all that stuff was relatively weak. I mean, how do we juxtapose these confidence numbers with some of this data that's coming in? And how does that resonate with, I think, both of our calls, which has been for lower bond yields here most recently?
Well, so I think a couple things. I mean, remember, right now, I don't think I generally don't think that the incoming administration has that many levers to pull like they did last time, right? Because, you mentioned interest rates. Interest rates aren't in the same place that they were 8 years ago. Inflation isn't in the same place it was 8 years ago. And the Fed's way of thinking about inflation isn't in the same place it was 8 years ago. So that limits some of the options that they can do next year in terms of sort of big bang fiscal stimulus. So one of the levers I do think that they can pull is just animal spirits, like keeping the hope alive, so to speak, right? And, we saw a pretty strong rally after the day after the election. You saw, you mentioned that small cap stocks, for example, did well, and so forth. And sort of that's, I think, going to be an important driver of how people feel. And keeping that going, I think, is important. Now, what I must tell you is when you look at the data, that confidence bump was very obvious in November of 2016. It's not as obvious today. So you mentioned consumer confidence. Consumer confidence did improve in the latest month. That was a November data point, but it improved actually more in October. If you go back 8 years ago, it was exactly the opposite. Consumer confidence rose a lot in November of that year. It didn't really rise all that much in October. So far, the Trump bump, if you will, has been pretty modest in terms of the reported confidence data. That's also true in the manufacturing sector. The New York Empire was sort of a knockout, but the data that's been released since then has been quite sluggish. The Chicago PMI was soft. These are, again, November data points. Philly Fed was soft. And I think that's a reminder of the kind of economy that Trump is inheriting this time around versus last time. Last time he was coming in at the start of a global synchronized manufacturing cycle. He was sort of riding that wave. This time, manufacturing is still sluggish here in the US, right? We have issues with Boeing, auto producers cutting back their production schedules because EV sales haven't been as strong. I mean, there's all sorts of little things going on. But broadly speaking, manufacturing has been quite sluggish. And that's not just true in the US, it's also true globally, right? I mean, you have Germany, which has been sort of mired in a factory recession for years now. The Chinese, there's been some enthusiasm around China, but the Chinese have a growing trade surplus, which means that their growth really isn't leaking abroad, right? Otherwise, they'd be running a smaller surplus. So it's not really doing much. I mean, maybe you can argue that some of their growth is coming at the expense of other people. So I mean, I think it's just orders of magnitude different, and that's being reflected in the data. So it's good that I mean, there's been some revival I mean, I would argue that it's mostly a continuation of the previous trend, but it's good that that's still going, but the options are somewhat limited in scope in terms of what the incoming administration can do. So I think, as I said, keeping animal spirits going, doing things to kind of keep equities going, I think that's going to be an important way that they can kind of influence the economy.
Yeah, well, certainly the confidence numbers seem to be higher. I mean, even, we posted on Twitter this week, the consumer conference board numbers, right, about stock prices, and certainly.
Right. I mean, so the stock price, right. So I mentioned that. I mean, right. Like, so
Right.
if you look at how people are feeling about equities, they've never been this bullish. Now you can do with that what you will. Maybe that's a bad thing. I don't know. But again, like keeping that going, I think it's optimism, right? And animal spirits. And that's important. Now the headline confidence number was not as strong. And then just finishing up with housing, I mean, the housing market again is a complete mess. If you look at new home sales, they fell. I mean, you can sort of chalk some of that up to the weather, I guess, because a lot of the weakness in new home sales was centered in the South. But generally speaking, I mean, interest rates backed up in October, and so that's weighing on housing activity. It's as simple as that. And new home sales represent signed contracts, so that's the leading indicator for housing activity. And so, I think the fact, and there's slack building in the single family market. I mean, if you look at new homes for sale that have been finished, I mean, that number's up about 50% against last year. So it's going to weigh on single family starts, I think, for a while. And I mean, we'll see. I mean, there's been some stabilization in purchase demand. But generally speaking, I think construction activity is going to remain quite weak for the foreseeable future.
Yeah. So we got our first taste of Trump talk in the last week. Tariffs on our good friends, both North and South, and I guess less friendly across the Pacific. More to come, Pavlik. Is this just the opening salvo, negotiating ploy? How are you viewing the tariff rhetoric here?
I think it's some combination of all of the above. I mean, just go back to where we were last Friday. We were recording this last Friday. Trump hadn't named a Treasury Secretary.
Right.
He did later that day, and the markets reacted pretty favorably to it, which I think they should, because I think he picked a really good one there in Scott Bessent. And so equity markets responded favorably, bond yields went down. But then that was sort of reflected on Monday's trading. And then what does he do after the market closes? He sort of, on his through social media, suggests the 25% tariffs against Mexico and Canadian imports and 10% additional tariff on Chinese imports. It's interesting levels because one, they're lower than what he had suggested and threatened during the campaign significantly. And that might suggest more of a pragmatic phased approach, which was some of the, I think, genesis behind some of the optimism with the selection of Bessent. And then the thing that he also tweeted out around the same time as those threats was the strong market reaction stories being written about his Treasury Secretary suggestion. So if you look at how the markets reacted the next day, currency markets, obviously the Mexican peso and Canadian dollar sort of fell, but I think the indices, broader indexes, largely just sort of dismissed them as threats. I think autos would be particularly harmed if they might have been hurt a little bit more. But that sort of suggests what the market's thinking. And they may be right, because on Wednesday, Trump tweeted out that he had a very productive conversation with the new Mexican president there, Claudia Sheinbaum, suggesting that this is just sort of a negotiating tactic. So I think that's going to be the thing moving forward, is sort of what we saw the last time, is a lot of threats. Whether or not that he follows up on all of them sort of remains to be seen. My guess is he will in some instances if these trading partners are willing to make some concessions. And if not, or if we get a little further down the year, we're looking for revenue to offset some of the tax cuts, and maybe he follows through with them. What's interesting about the three players, like Canadian Prime Minister Justin Trudeau, Chinese President Xi Jinping, they dealt with Trump in the past. I think he may have been testing the waters there to serve what he could get away with Sheinbaum, because that's somebody who is not familiar with negotiating directly with Trump. And, I think it could also make the case that he's probably looking to accelerate this negotiation on the USMCA ahead of 2026. I mean, strategically, it might make sense to sort of shore up the situation here with Canada and Mexico before maybe pivoting stronger to China. I know that's something he tried to do the first time. He just looked sequentially with USMCA before the tariffs ratcheted up. So I think one thing that was notable too is, Trump made this announcement before he named a USTR, and he ended up naming Jamieson Greer, who was his former USTR, Bob Lighthizer, chief of staff. And I just wonder, being somebody who works for the person is different than being the person. Lighthizer was somebody who had a lot of clout within the administration and on Capitol Hill. And obviously, Greer's views are going to align with Lighthizer, but is he going to have the same sway within the administration? Not sure. The fact that Trump also tapped Kevin Hassett, who worked for him before as chair of CEA, now to be his chair of the NEC, National Economic Council, I think is encouraging. So, the absence of Lighthizer right now from having a defined role in the administration, the absence of Peter Navarro from having a defined role within the administration as we're recording this, that may suggest a softer approach to tariffs than some of the more, I don't say draconian, but the more stringent policy suggested on the campaign trail.
Are there other positions for them to fill that? I mean, it doesn't sound like the prominent positions are there. Is it,
Well, it's been suggested that Lighthizer could come to the White House as sort of a trade czar position, but it's sort of interesting because USTR is actually out of the White House. Even though it does require Senate confirmation. Lighthizer would have a problem getting the Senate confirmed. So, I mean, is he just holding out to get this sort of trade czar position so he can sit, a little closer in proximity to the president, which proximity is power. Don't kid yourself. Real estate is very important here in Washington. But that sort of remains to be seen. Absent that, I'm not sure.
True story. You like this one. A rising NYU senior, once worked with as a research assistant on Kevin Hassett at the American Enterprise Institute on a piece. You want to hear it? Media bias of reporting economic news. That rising NYU senior was me.
What were the conclusions of the report?
What do you think?
I think hovering NYSC student would have been probably the more appropriate moniker.
But I worked on I was a research assistant for Kevin Hassett when he was director of econ at the American Enterprise Institute, among many. But one of the pieces that we worked on was a piece about media bias and how the media reports economic news.
Good person to work for, Neil?
I was actually working with him and another economist who I dealt with actually more. But yeah, I mean, he was very friendly. I mean, it wasn't.
What year?
I think that was 2004. I'm gonna say.
So well before, I mean, the whole crumbling of the media's integrity.
Well, I think the media has a tendency of playing up bad information. That's I think natural. They just happen to do it more under one party more so than the other, and that's what the piece found is that for the same sort of set of data, I mean, it was basically a coding of headlines. I mean, that was the analysis. I mean, I don't want to get too into it, but it would be like. It would for example, it would be like jobs growth surges by 200,000. That would be the headline for one party. For the other party, it might be job growth surges 200,000, but unemployment ticks up.
Right. 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 Yeah. Still good. So let me throw this grenade out there, guys, because I think it's interesting, and we'll see how this plays into the global chess match. But have you been following this decline in the ruble, over the last 3 or 4 days? Just wondering, Steve, maybe this is in your up your alley from a strategic standpoint, with what's happening, obviously with the war in Ukraine. Does this force potential negotiations, ceasefire? Is he going to want to get something done because, of these sanctions and some of the other obviously impacts that it's having on the currency? I mean, look, when the leader of the country comes out and says there's nothing to see here, it's usually a sign there's something to see here, right? So I'm just really curious as to whether or not, and this kind of seems to be flying under the radar. And I'm always looking for kind of those dislocations that are potentially large in impact, but are small in terms of the attention. What are your thoughts there, if any?
Well, I just think of what the election impact may have to the negotiating position for both Russian President Vladimir Putin and Ukrainian President Volodymyr Zelensky. I mean, I think it's pretty clear under a unified Republican Congress that you shouldn't expect much continuation in the amount of aid, both from arms as well as financial assistance from the U.S. I think probably not a coincidence that the Biden administration is trying to accelerate the weapons use. That a lot of these weapons that they held back before the election. I don't know that that's catching Trump off guard. I think that's probably one of the things they talked about when they met after the election, because I don't see Trump being critical of that. I think Trump appreciates leverage, and my guess is he wants to make sure that the Ukrainians have some form of leverage coming in here, because I don't think he wants to. I don't think he wants to deal with the conflict. He can have enough things to deal with domestically and also on other trade fronts. It's one thing he'd probably prefer not to have to focus a lot of time on, candidly. And I don't know that he wants to sort of enter office as seeing some big capitulation to Putin right off the bat. And perhaps Putin sort of seeing the writing on the wall. This conflict's going on a lot of time. They're having trouble retaining their forces, dealing with this war of attrition. And Trump may have something to offer Putin in terms of a relaxation here of some of the financial sanctions. Maybe now they're being a little enforced more dramatically, pull some of those back. So there's a potential way for a quicker conflict here. I mean, at the end of the day, we always thought that this is going to be negotiated settlement. There's going to be some territorial concessions on behalf of Ukraine, and usually the generals fight the wars, the politicians are the ones that declare victory. And my guess is we're probably moving more towards the latter there. So, I don't know, maybe that's sort of what's impacting the situation there with the ruble, but would it surprise me that there could be a ceasefire in the cards relatively soon? No, I think it's sort of in both sides' interest to come to the table here. And I think they're sort of recognizing that. Whether or not that's going to be durable, whether or not the U.S. is going to provide some sort of NATO assurance to come to the assistance of Ukraine, maybe indirectly through that, to try to prevent Putin from seizing more territory in the future, I think is sort of the outstanding question, but that's sort of how I'm thinking about it.
Yeah, and I mean, you always worry about dislocations in currency markets, and I say that for those who don't have a lot of experience in our world. Oftentimes, the currency markets are kind of the first safety valve, and volatility in the currency markets are often the early indication that there's something amiss. So, we saw it didn't follow through, frankly, shockingly, with the yen back in the summer. But certainly, it has happened with the ruble before. Happens oftentimes with Argentinian pesos and real and the like, Thai bahts, etc. So currencies are often a focal point for us because that volatility is a sign of bigger dislocations and things that might need to come back into line, including our good friend Scott Bessent, who was famous for helping to orchestrate the breaking of the Bank of England with the pound because they were on an unsustainable track, right? I mean, that's the way it works. So let's talk a little bit about seasonality because we are entering this period for the markets in December, and I know fourth quarter is generally strong anyway, but I think what gets missed is just how strong December is. Roughly median returns of about 150 basis points for the month of December, average returns about 130 basis points. That's important because you want your mean and your median to be close. When they're close, what it implies is that the significance, the predictability of that relationship is likely to hold. So December tends to be a good month. Importantly, though, January also tends to be a good month with about the same return. So we're staring down the barrel of the next 2 months, seasonally being very, very important. That does not guarantee anything by any means for all of you who play in the financial markets world. But what I would liken it to is a blackjack game or a hand of blackjack. And if you're looking at holding a 19 and the dealer has a 6. Historically, you've got about a 70% probability of winning that hand, and it's exactly the same here for December and for January. So the difference, which I think is important and people miss, in blackjack, if you put up a dollar, you're going to win a dollar. In the markets, oftentimes there'll be asymmetric skew to that. In other words, if you put up a dollar, you can win $1.25 or $1.50. And so when you get those probabilities that are in your favor, but you also have that payoff skew, it can really end up being a home run. So, like what we're seeing there from a factor perspective, interestingly enough, beta also tends to have a very similar trademark in that December is strong. January, not as much, but it certainly still suggests that there should be risk on. Neil, you talked about the conference board and people's confidence around equities. It's one of the things that we actually follow. It tends to be a little bit more contrarian than not. So I think one of the things that we're going to have to watch as we get into 2025 is going to be this elevated bullishness in the market and in sentiment. It's not as good at tops as it is at bottoms, no doubt about that. But the whole notion or idea is that if everybody is bullish and they've committed, who's left to be a buyer? We'll see if that ends up playing itself out or not. But certainly, I like what we're seeing from a momentum standpoint. I don't think sentiment really has tipped into that danger zone yet, but I do think it might be something that comes out in the early part of 2025. Did you learn anything from the minutes this week? I felt like, and maybe because it was a short week, that they kind of got short shifted in terms of what the minutes stated. Were there any surprises from the Fed in the minutes this week?
Not really. I mean, I think, the markets are still pricing in a December rate cut.
Right.
I mean, I think the odds are, I mean, to me, the Fed is basically, forecast and data dependent, right? So it's not just about the data as it's coming in. It's also about how they're thinking about the outlook. And, if I had to guess, I would basically say they cut in December, but they erase several cuts for next year, right? Like, because the economy has done a little bit better than they thought, but, since September.
Yep. Yep.
So
Well,
they have
certainly.
four. They have four in now. I mean, maybe they go to two. That would be, that would be the hawkish outcome, I think.
Yeah. So we had some questions on our China call. Obviously, the momentum has not followed through as much as we would have preferred, but the whole basis, or I should say, one of the pillars of the China call was the improvement in trend. So the momentum was strong enough that it pushed the trends from negative to positive, and now it's just retracing some of that momentum. I don't look at it as a problem. I think it's the 2008 moment for Xi Jinping and the leadership there. If you look, you'll see that bond yields. We actually put this on Twitter. We'll put it here on the YouTube channel as well. But Chinese bond yields are sliding now, approaching 2%. You've got these policy initiatives, very similar. I mean, tell us if you've heard this one before. 111 billion reserve repos being purchased, 200 billion, I'm sorry, 25 billion dealer purchases from banks of foreign bonds in November. A potential 25 to 50 basis point reduction in reserve requirements likely in the coming months. So obviously, they're leaning into it. And I know people talk about central banks out of bullets and there's nothing you can do, et cetera. But look at the relative performance of financials. They are part of the leadership pact of China. That's not something that was happening here in the States in 2008, 2009. In other words, the idea that there's these massive black holes and we don't really know what's happening, you would not expect to see that type of weakness in Chinese financials if in fact that was the case. And keep in mind, from 2008 in the first quarter of 2009, financials were leading to the downside of that. So clearly, our situation was more tenuous than what they're seeing.
Yeah.
How about next week? What do you have for data?
Jobs. Next week is, we'll see. I mean, the markets are looking for 200,000 on payrolls. A lot of that's going to be a undoing of some of the things that were depressing employment in the month prior, right? Like, so you had the Boeing strike, you had hurricanes. So we'll see what's going on.
Do the Scarborough show up yet? Are they on the jobless report?
The one thing I would say is initial claims are down, continuing claims are going up. So that tells you that the hiring rate is very weak. It's hard for people to find work, which is really how the weakness in the labor market's showing up. We'll also get ISM, which will be, again, important. We talked about some of those regional manufacturing data. They've generally been on the weaker side, with the exception of the Empire Index. But all signs point to another sub 50 ISM.
Steve, what's happening next week in Washington?
Congress returns next week. Got a 3-week sprint here until the December 20th government funding deadline. There had been talks that they would do some sort of try to do some sort of omnibus spending package to get through September next year. Don't think that's going to happen. We would have seen the text by now. I think for Speaker Johnson, he's preferring a stopgap probably into February, March timeframe, the continuing levels, because he has to win his speaker's vote on January 3rd when the new Congress starts. I don't think he wants to anger fiscal conservatives here at the end of December when he's going to need their votes a few weeks later. Recall the situation beginning of this current Congress, where it took several rounds for then Speaker McCarthy, to get the gavel. So I'd be surprised if that's not what's really going on here. We'll still see the defense bill move. That's moved the last 6 decades. So that could be the potential catalyst for some of these other things to hitch a ride, like outbound investment screens and the like. So.
Excellent. Well, from the market perspective, we'll be watching some key levels. The S&P 5832 is the important tactical support level. We'll be watching that one. And we're right now approaching the first support level for yield, which is roughly 420. We're at 419.75 right now, so right in that zone. I suspect we're going back to 4%. We've taken some heat for that, I know, but it is what it is. I mean, the charts are the charts. 450 is the upside and the resistance level there on yields, but again, we think that trajectory is likely lower. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and YouTube if you want to see some of the stuff that we're talking about. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.